that's where my analysis kind of starts. You know, you have to be aware of, when I show you these trades next, all right, so I get in the trade here, where's my stop go? Okay, that's your answer. And remember now, a tick equals 31.25. All right, 10-year notes trade in half ticks, 5-year notes trade in 1/4 of a tick. All right, on the floor, if 5-year notes go from 15 to 15 1/4, that's 1/4 of a tick, and it's worth 761 or something. All right, so remember that. A tick equals 31.25 on the floor. Nobody down there will ever say, I'm short at 22/64 or whatever sometimes you hear retail people saying. All right, so you have to understand that that's, when I say tick, that's what I mean. Now, this next spreading hedging thing, just so I don't start flipping through slides and losing my place, I'm going to cover it now, but it's a little more advanced thing, but I think it's a real helpful thing. And what it is it's, you know, again, like a knob spread, where you're doing 10 10-year notes to 5 or 6 bonds, or 5 10-year notes to like 3 bonds. Okay, and my point to this is, you don't just put these on. In other words, let's say you get short the bonds, and so it's going against you. Well, you don't just buy 10-year notes. You have to put these on at levels. All right, maybe the setup I'm going to teach you occurs in both the markets at the same time. And you say, you know what, I like the setup, but the market's been so vicious today or squirrely today, I'm going to hedge it. I'm going to take the short in the bonds, but I'm going to hedge it against the 10s. All right, but again, you don't just do these anywhere. We'll use them at levels of my newsletter. We'll use them at major transition points in the market. But I think it's a useful tool to be aware of. And you guys are more advanced. I mean, a lot of the trade in the pit is done this way. Is done as a spread. And it's just, you guys are advanced, looking for a way to kind of get into the market and really have your risk reduced. Keep these in mind. FOB, where you're doing 5 years over bonds, and you're doing 10 5 years to 3 or 4 bonds. It's not 3/4 of a bond. It's 3 or 4 bonds. So you can do 5 years and 2 bonds. All right. And again, it's a way to keep your risk less. You don't get the bang for your buck, but your risk is less. Okay. And then there's a fight, 5 years and 10 years, 10 5 years to 5 10 years. And I just make it something to be aware of. If any of you guys join me with my service and get my newsletter, you're going to see that almost daily now with these markets, we're coming across transitionary prices where we're looking to see who controls that price. Well, a more aggressive trader can say, I know this is the spot that's going to change this trend. So they'll put out a spread at that spot. All right, and it's things we can talk about later, but all right, let me move on here and see what's next. I know there's some slides. I have no idea. Yeah, I'm going to skip these. All right. Let me stop at this one, because this is a bond order book and a 10-year order book. And I can just kind of go over with you again about when I say a tick. All right, so let's just say, for example, I say to sell bonds at 140.23. So you put your order at 140.23 and your stops at 27 or 28. Okay, I think we all kind of understand that. All right. If I say sell bonds at 23, and I say your initial target, you want to get 2 or 3 ticks. So you sell 23s, when you can buy 21s or 20s, you're taking something off. You're moving a stop to scratch, and you're seeing if the thing can keep going for you. 10 years, if I say to sell 10s, you put your sells at 10, and your stops up at 12, or maybe 12.5. Okay, that's 2.5 ticks. 10 to 10, half is half a tick. That's worth 1561 or something. Okay, 10 to 11 is a tick. That's 31.25. All right, and then if I say when it goes your way, a tick or tick and a half, you take a profit. So if you sell tens, you can buy nines or nine halves. You're taking some off. You put a stop at scratch. And I'm telling you, it's easier to trail a stop in tens or fives. People, one thing I've learned over the years is people look at a bond chart and they say, well, it just chops, it doesn't move. And I always say, that's you're wrong. All right, but it's the chop that we use to exploit. All right, we exploit the chop when we trade, and the bonds get a little more whippy, like I said, head fakey, and it's got a much better chance to stop you out than tens or fives. You look at tens and fives just sitting there on a bar going, well, it doesn't move, but that's what helps you not get stopped on your trailing stops. Now, I want to go back to something that we're doing a ton lately in the market. And I'm going back to this. All right. And I mean, I am trading just boatloads of 5-year notes lately. All right. I should change my company to trade 5-year note futures. All right, because I want the lower risk that the 5 years give me. All right. And the chance to trade size. All right, and when I say size, trust me, it's not anything. It might be 4, 5, 6, 7 contracts. But bonds, if I would trade 7 bonds, something's wrong. It must not be my account. All right, I mean, I have a healthy fear of the bond market. The point I'm getting at is Monday when you're trading, the bonds may get to one of these things I'm going to teach you about today. And you might say, you know what, I don't really like the trade, okay? Or you might say, I just met the guy Saturday, I don't trust him, so I'm going to try it in 5 years, all right? And that's what you can do. You can enter a 5-year trade when the bonds are hitting a trigger, or you can enter a 10-year trade when the bonds are hitting a trigger. Now again, you don't get the bang for your buck, but you're in the market at a good spot and you have lower risk. Now take it a step further, all right? You sell bonds at 10 and you buy back some 8s or 7s and it goes 6 off or 5s trading and you say, holy cow, I got this one. I got this one. All of a sudden it goes 6 bid, 7 bid, okay? And you say, oh geez, okay, well, okay, nope, 8 bid, 9, okay, I'm taking my tick. And then it goes at 8, at 7, at 6, at 5, at 4. Okay, happens all the time. I'm sure you guys are shaking nodding your heads going, oh yeah, oh yeah. This is what we do. We get a bond trade that is that good, or we got 6 ticks into it, we cover. But we'll hit a bid in the 5 years. All right, now think about that. My example is you sold 10s, and you can buy back 6s or 5s. It's a great trade. So you say, I'm taking them. I'm taking these 5 ticks. So I'm hitting a bid in 5 years. I'm going to risk a tick. Now, bonds keep going. 5 years are going to go, all right? I mean, bonds might go 6 more ticks. 5 may only go 2.5. But who cares, okay? You kept yourself in the market, and you cut your risk down. If the 5s go against you, you lose a tick there, but you still made, whatever I said, 3 or 4 in the bond trade, all right? It's been so useful to us, all right, to use that. And, it's... I think, again, you guys that trade the bond market, I know you're saying, wow, that's going to help me. You guys that aren't trading the bond market, probably a reason to trade it because, I don't know anything about the currencies. I don't know anything about the grains. I don't know anything about what else, anything else, the crude market. But I'm not sure those markets have that kind of thing. You can hand a trade off like that. Where you can hand it off and say, okay, I'm taking my profit here, but I'm going to stay in the market with this less risky contract. It's a great tool to have. All right, now, what the histograms are, okay, and, I mean, I use this a lot in my trading. And you guys are in the MTS room, and you probably don't see me come in much or hear me come in much. If you're just starting an MTS trial, you won't see me come in too much, because in the MTS room, well, I'll finish my thought. In the MTS room, you have to type, and that's not what I mean. I can't type. I gotta watch the keyboard when I type. If I'm watching the keyboard and then making sure I don't butcher my spelling or have a typo on a price I'm giving you, I'm not watching these things. I'm not watching these things, I'm missing trades. Okay? My responsibility is to my clients in my trading room to keep them informed of what I'm feeling, what I'm seeing, my thoughts on the market. And I get a lot of that thought from watching the order books. So the way you use them, okay, here's bonds. This is called, I call this a low volume pocket. All right, a low volume pocket. Obviously, the market liked this 13 price. They traded 17,000, they liked that. And then something happened, a number came out or something happened, and the market pretty much didn't even trade all through here. Just kind of blew through this, and then everybody thought this area. All right, and and I use the term value, but people decided that this is where these prices were good, buyers and sellers. Okay, so a lot of trade here, but nobody traded here. All right, so let's say the market's trading down here. I'm gonna leave the mouse there. All right, and you say to yourself, I want to sell this. Okay, people are finding value here. All right. Let me take it a step further. Maybe this is one of the setup I'm going to teach you in a few minutes. You say, okay, I'm going to sell this here. All right, where's this thing wrong? Okay, where's this thing wrong? Where am I going to be in trouble being short? Well, up in here. All right, if you sell 13s and the market starts trading 25, 26, it's probably going to run on you. And because it's going to want to fill this stuff in, all right? They're going to want to go back up here. I call it the test retest. And again, I'm talking about the bond market. Mini Dow does this, S&P does this, all right? But the market's going to want to go back up here and trade here. And what we call it, they want to see what's up here.
Jack?
Yeah.
Jack, this is Marlon. I didn't want to interrupt you, but I'm going to. You need to turn on above the ladders. You'll see the little pencil with a.
I got Tony here showing me something.
Okay.
All right. So what do I do?
We're missing some good stuff without that mouse.
All right.
Richard just put his glasses on. I did too, Richard.
How about that? Have you seen a mouse now? Or a black arrow? No.
I don't. Do you guys see anything?
No.
Me neither.
Hold on. I got Tony helping me here.
It's a little red dot. There you go. The red dot. Follow the red dot.
All right.
Just be careful putting it inside your red prices. Thank you, Jack.
All right. No, thanks, guys. Thanks. All right. So let's go back over it. This is, when I say histogram, I mean this thing right here. Okay. Traded volume. Okay. This is where people put their money where their mouth was, and they traded here. All right. So I call this is a low volume pocket. And what we're saying is people like this price here, this 13. They traded 17,000 there. So, and again, I mean, that's how we talk on the floor, people. Was it Goldman Sachs doing 17,000? Who cares? All right. Was it 17,000 one-lot guys in Iowa? Who cares? Okay. Well, the second one, maybe. But the point is the market liked that price. Okay. So then the market, something happened, a number or something, but the market blew through all this. And then people decided that they liked this area. All right. So as a trader, all right, let's just say that a setup I teach in a few minutes tells you, let's say the market's trading down here. All right, trading down here. And the setup tells you to sell 16s. So you say, okay, well, I'm going to sell 16s because I still kind of latch on to some heavy volume. But I'm going to be in trouble up here. I'm going to be in trouble up here above 26. All right. Now, we didn't talk about using a 10-tick stop earlier, but if you get stubborn when it starts going against you, at least you got a place to say, you know what, I'm history here if it gets above 26. All right. That's how you can use a low volume pocket. For me, let's be something that's kind of more realistic. Let's say the setup tells you to sell 23s. And you say, boy, I'm barely catching the top of this. And because this thing goes, if I get stopped on this, it's probably going to run. And I probably got to reverse. All right? You know, because you're barely catching where some people liked it. Up in here, you know, it can run up here. So you say, okay, I'm not taking this trade. I'll do it in 5 years. I'll do it in a less risky sector. I'll trust the setup. I'll trust my history going to give me something to kind of hang on to. But you can see it's like a mountain climber hanging on by his fingernails, you know, because he's got nothing here to help him. And that's where you say, I'm taking it. I'm going to do it in 5 years. All right. So it helps you to know if you're trying to sell the place you're wrong. Now, the other side of the coin is, what if there's a setup that had you buy, like in here, and it's actually going your way, and you're saying, holy cow, you know, where can I add to this? Which we almost never do. Adding to a winner is, people always talk about it, pretty hard to do. All right? It's almost more, you say to yourself, where's a place I can relax on this? And I got this thing, you know, and you say, boy, if they get this thing up here, I got this thing. You know, I mean, I probably got another, 7 ticks from here. So that's how you use a low volume pocket. Let's just say we're trading up in here, and the setup tells you to buy 13s. And you got to say, great, I love that. You know, the market has shown me it likes that price. All right, great, I love it. All right, a 4 or 5 tick stop, you're down in here. You're going to puke these at 7, 8. And, you know, again, you may even say to yourself, if I get stopped on these, I may reverse. You know, reversing in the hands of a novice is bad. You're better off taking a step back from the market and just, okay, that didn't work. Let me just take a step back. But there are times, all right, that you have to reverse. All right. I mean, I've had setups that have failed so badly that I go from a sell to a long. All right. I mean, almost like, I sell 12s and it goes 13, 14, 15, 16. I'm reversing at 16. And invariably you get your money back. Because you can't be stubborn. I saw some people comment earlier about when I come into your guys' room how you said something about being calm. Well, you have to be calm. You have to trust what you're using to put your trades on. And you guys who are new, and maybe hearing me for the first time, or maybe just starting your MTS trials, and I'm talking to guys that have just been kind of bouncing along for 3-4 years. You open an account up, you pissed away half of it, you built it back up, and you just kind of drift along. You don't hurt yourself, but you're not making money. That's where you can just, you're a trader, so to speak. And I'm talking to you guys with this. Well, to me, that's through no fault of your own, because unfortunately, for the retail business, the people that can go out and promote themselves, all right, and sell DVDs and do webinars and like, here I'm doing one, but you know what I mean. Those guys aren't traders, all right. But that's the stuff that you get sent to your mailbox or you come across at these trade shows. So it's not your fault that you're getting crap information, all right. And you have to get yourself in a situation where you can trust the stuff, because then there's no emotion. And that's where you want to strive to get as a trader. And one thing that an old bond pit trader said to me years ago, and I remember it, and I probably say it to myself 100 times a day. The market's job is to get you in bad trades and keep you out of good trades. So when I sell a nice spot in the market and trailers stop and my trailing stop gets hit and it goes my way 5, 6 more ticks, I don't say, you know, F and market and BS and all. I say the market did its job. But I tell myself that means I'm right. And next time I get a chance to sell, I'm going with more. All right. So, you know, there can't be emotion in trading. You know, I have a lot of long time friends on the floor. The guys been trading 25, 30 years. And they all say, when I get emotional, I just piss away money. You know, I mean, and these are veterans. You know, these are guys, and so my point to you new guys is, you see how fragile it is. All right? It's a constant battle, but keep the emotions out of it. And just, you know, all right, here's my setup, here's my trade, I'm taking that trade. Okay, trade the loser, where's my next one? You, as a guy said to me years ago on the floor, you trade the process, the money takes care of itself. All right, I'm giving you guys some parts of a process that's going to put you in good trades. All right, so I think we beat this dead horse with this low volume pocket enough. This 10-year one, you know, what I'm going to talk about on this one is, and you see it's trading right here, but this stuff here in the bid-ask column is, you know, it's fake. I mean, and it's been fake for years. You know, people are all, the hot button now is algos. And to me, that's another excuse that a trader has why he can't trade. You know, back in the old days, when people put orders in the pit, there was, you know, that effing broker screwed me, or the locals went after my stops. That was all BS. You know, there's always an excuse people have why they can't trade. And they say it's the algos now. Well, I don't care what this stuff is, okay? But to me, it's not real, all right? I'm not looking so much at the bid ask. What I'm looking at is abnormally big stuff. Here's a guy trying to buy 3,710 years at 05. Okay, that gets my attention, all right? If I'm short and the market gets close to him and he's still there, I'm taking some profits. If they get down to him and sell him 500, and he comes back and shows the exact same size, 3,706, I'm getting out, because he's down there in the weeds. That's what we say. He's laying in the weeds with it. He might want to buy 10,000, but he's showing 3,700. All right, so that's how you use that stuff. Let's say one of the setups says to buy 6 halves or buy 6s. All right, you can lean on him. All right, now maybe he's fake, but you'll know. You know, you get your 6s, 6 halves. It's a setup, first of all, so you can trust it. And maybe that's your second reason. Maybe when you're filled, he disappears. Okay, well, all right, you know what? I'm in, but I'll be more careful with it now. All right, but you can use him. And again, just this big blob of histogram volume. I mean, everybody thought this was value. So if we're trading down here, we're trading the lows, 0.2 half. And all you know is histogram trading. And you say, where can I sell this? I can sell it up here. I can sell it up here. I can get against this blob of volume. If it goes against me, it's not going to run. You know, too many guys like this here. You know, it's not going to run. You know, if a setup gets us long down here, and we take a little profit and we're trying to trail a stop, and we say, you know, where might this thing bog down? Where might this thing stop? Right here. So if it gets here, you either tighten your stop way up, or you take some more off. You know, but you have to honor what the market's showing you. All right, now I'm going to try and change the slide. And this was from yesterday. All right, this is a bond chart. This is taken right off of my desktop. And you guys that might email me when we're done here and join me, what what you're going to see in my room is my 4 charts, my 10-year, my 5-year, my bond, my S&P, and my bond and 10-year order book. And it helps the students in my room. All right, and my room is probably 90% pro, but I do get new traders, and I do like work with new traders. All right, but you'll be able to see. I'll say we're going to sell these 15s, and here's why. Or we're going to sell these 15s and puke them at 19, and here's why we're going to puke 19s. It helps you think the market through as a trader. All right, but this on my charts now, all this stuff isn't on there. Okay, I mean I don't, but I did it for this webinar. I did it. All right, but anyway, all right. The market reopened Thursday evening at 17:05 Central. I have no idea what time that is. I don't know. All right, but my charts are Trade Navigator, and there's a little dashed line right there. When I come in the morning at 6 o'clock in the morning, I scroll back my bond chart. I find that dashed line, and that's when the overnight session started. All right, when the market reopens the previous afternoon, like tomorrow evening, when they open the market for trade, that's when the overnight session starts. When they ring the bell to open the pit, that's when the overnight session ends. All right, so what you do is you take the overnight high, that's this dashed line here, and the overnight low, that's this dashed line here. The overnight low was 135.26. All right, what you do with that is you go 16 ticks below that, and you put a buy in. So 135 minus 135.26 minus 16 is 135.10, right here. You put a buy at 135.10. You stick it in there. Bonds are first in, first filled. All right. Doesn't matter if Goldman Sachs wants to buy 10,000 and you want to buy 1. If your 1 goes in before Goldman Sachs' 10,000 and they trade 1, it's you. All right. And your broker does not charge you to place orders. He charges you for fills. So put the order in. Put your 10s in, put a stop at 06, a stop at 05, and the order's sitting there. Okay? Now, and I'm going to jump to that trade first because look what happened. Went down to 07, okay, you weren't stopped, and it went 18 bid. So there's 8 ticks in the trade. All right? And that was yesterday, and these markets, I don't think I bought mini Dow once in the last 2 days. We've been selling the crap out of mini Dow. We've been selling the crap out of the bond market. All right, but it's a setup. All right, and it gives you that one spot. You say, okay, you know what? Let's try it. And this is simple stuff. I mean, if you guys are looking for me to tell you that, that the Keltner band has to roll over before 2 o'clock on a Tuesday afternoon, and the Andrews pitchfork has to align with the full moon, you ain't going to get it from me. Okay? This is simple stuff that I picked up being on the floor. All right? And this is how floor people trade. All right? So there's your trade. All right? You go above the overnight high, 16 ticks, and you put sells in. You put your stop on, and you leave the trade in. All right? I mean, now there are times that I cancel those. All right? Well, I'll tell you this. There's a lot of times that I actually pass on the trade. But one of my clients, who's an aggressive trader, but he tells me that trade alone pays his mortgage every month. And he's not trading size. I think he does 2, 3, 4 contracts. Okay, this is probably my best setup. All right. Now you say, wait, but you just said you pass on it. All right. Well, you have to understand something. Okay, you trade for yourself. All right. I mean, and I gotta take trades that I like. I like momentum. I mean, yes, I do take this trade, but not every day, every single setup. All right. Remember I said earlier, I like confirmation on my trades. All right. Is there a second reason to take it? A third reason? All right. That type of thing. Now, when do I cancel this? All right. Well, let's say I'm parked up here, safely away from the market. All right. I'm 16 ticks above the overnight high, but we run up, and let's just make it up here. The sell's 20, and we're trading 16, and it's 8:50 a.m. and they release Michigan sentiment in 3 or 4 or 5 minutes. I'll probably cancel it. All right. Now think about it. I mean, because you may get run over on it. Now everyone cancels. So if the number comes out non-event or goes down, you stick it back in, you probably won't lose your space, your spot in the order book. But that's the only time I really cancel this. Let's say I got it in and we're trading maybe 10 ticks away from it, but there's going to be a bond auction in 5 minutes or 2 minutes. I'm probably going to cancel it because you can get run over. All right, but in other than those situations, you got to trust it, because the market wants you to look at that and say, man, this is not going to work. This is not going to work. I mean, they'll make it look so bad, and you're going to say, no, I can't buy this. And it'll be the low print, and it's going to bounce, and you're going to say, wow, you got to trust it. Now, the other part of the trade, it's a 16-tick extension. Okay, that's what I call it. Okay, is a reversal. All right, you put this low at 23 in. All right, 16 ticks from 23 is 07. So when it starts to bounce, I go put to 07 and I put sells in. Put my stop at 11 or 12. Okay, and I'm in. High prints 10, I'm filled. Okay, take my profit, trail a stop. All right, I mean, some of you guys are probably scratching your heads going, you got to be kidding me. But that's how we trade on the floor. Okay, that's how we trade. All right, 16-tick extension, put a 4 or 5 tick stop on it. When it goes your way 2 or 3 ticks, take a profit, get your stop to scratch. When you fade the market, which is what the extension trade is, this one is, you're going against the market. Okay, you can't work the trade. I pop in the MTS room where the guys on trial are. I try and get in there for an hour a day and just see if anybody has any questions or share some thoughts. And I'll bet you I saw of all the posts, probably 95% were buying the S&P the last couple of days. And I don't know. I mean, I gotta tell you, when you're going against the market, you cannot defend the trade. If you're wrong, you have to be out. All right, you got to stop yourself out. All right, if I buy these 10s and they 9, 8, 7, 6, 5, I got to get out because I'm on the wrong side of the market. When I go up here and I can sell these, I'm on the right side of the market. So I can, if it goes against me, I can say, you know what, I think I'm still good on these. I'm going to give an extra tick. Or when it goes my way 2 or 3 ticks, I can say, you know what, I'm on the right side of the market. I'm going to try and get 4 out of this before I move my stop down. All right, because you're on the right side of the market with this reversal trade. Okay, and it's such a useful tool. Money management. Again, when I have coffee with these guys on the floor, and I'm just listening, because these guys have been trading 30 years, and they say trading is money management. All right, and invariably, what happens with a newer trader is they buy this, and then they're looking for the home run. And they get stubborn with their out, or they just get stubborn with their greed, and they turn a nice trade into a nothing. But yet, up here, where they're on the right side of the market and can really go to work on it, a little more size, try and hold it longer. You don't see it. You don't see it. And if you guys got to just remind yourself of that. When you're on the right side of the market, you can trade more size, you can hold winners longer, and you can defend your trade. All right, meaning when I say defend, I mean if I sell sevens and it goes against me, and I have another reason to sell it. Okay, I can't just make one up, but maybe a newsletter level is there, or maybe there's something else that the histogram gets fat there. I'll say, you know what, I'm going to try one more try here. I'm going to sell more. That's what defending means. Okay, I got short at 7, and I should be puking these at 11 or 12, but the histogram says I can lean on 13. So I'm going to sell more at 12, and if the whole thing goes up, above 13, I'm just going to puke out of it. I'm getting out of it. And you have that right when you're on the right side of the market. You don't have that right when you're down here fading. And I guess, you guys are new to the market. I think you have to get that concept, because it's going to save you so much money and probably make you money. All right, and I mean, I don't want to beat that dead horse anymore, but that's that concept. Now, there's not a lot more. Yeah, I took this from yesterday's order book. Just another low volume pocket here. But I may have covered. I don't want to show that one. It's something I wanted to show because there are comments from some of my clients. But I cut and pasted it for myself, and I want to get their names out of it. I think trading and something else, you guys on trial. I mean, and I don't want to turn this into a MTS trial webinar, but the tools that you learn, the tools that you have should be your tools. And don't be so quick to share stuff with people that you don't know. I know it's fun to be in a room and bounce ideas off people and share ideas, but I mean, like me here, would it really cost me anything to give you guys everything I know about bonds for nothing? No, but is it fair to my clients who pay for it? Is it fair for me to have the one guy in here who doesn't really have the best intentions to get my stuff? No, and I think you got to think about that when you learn a way to trade. I mean, yeah, there's something about giving something back and sharing and helping people, but just keep your toolbox to yourself. All right, well, I'm going to see if I can answer any questions. And I'm not going to scroll back up here. The first one I see is, what is the green line? Point of control. No, no, it's not point of control. Now, that's a good tool, point of control. That's a good tool. I have a client out in Phoenix who, before he even met me, was a very, very, very accomplished S&P and mini Dow trader, and just wanted to add my floor stuff to his thought and just be in the room. And all his stuff is his market profile. So I know it's a very good, okay, I'm losing some questions here. And again, I'm not going to scroll up and see what people have asked. If I don't get to your question, my email is in here, and you can email me. All right. Let's see. If extension and reversal sets up in bonds, you sometimes take it in 10 or 5-year notes. Absolutely. Absolutely. Yep. If the question is if extension, let's see, can I lock this thing? Well, okay. If extension or reversal trade sets up in bonds, do you sometimes take it in 10 or 5-year notes? I would say not sometimes, I would say often. Often. Okay? Absolutely. Yes. Yeah, and that's a great question, and yeah, that's how you use these markets. would it be fair to say you buy high and sell higher and sell low and sell lower? Would it be fair to say you? So I think you're asking me. Do I buy high and sell higher? And well, if you've heard me in the MTS room and stuff like that, I am a breakout trader. I am a momentum trader. And yes, I mean, we do have breakout trades where we probably sold new lows in mini Dow 50 times the last 2 days. All right, and took 6, 7 ticks every single time and caught some runners. All right, but yes, it's now you can't put me in that little whatever you want to call that, because I do fade the market, but I do love momentum. Where yes, I will sell new lows and bonds and look for follow through. Now, if invariably if you sell a new low, okay, it's going to pop back up on you. So that's where you got to be able to defend the trade. If I sell new lows here, there's a bond chart. All right. If something tells me I should be short at 27, when it's 27 offer, I'm joining the offer, and I might hit a 26 bid if they start trading. All right. And if it pops up on me, I know, and I know it's probably going to, I can defend it against this histogram. I can go up here and say, okay, I can sell more at 02. I can sell more at 03. And, and I don't want to go a lot longer. I'm not sure what time I started, but I think we all agree that the weather is getting nice around the country, and I think we want to get out to enjoy it. But here's something to put in that, all right? You sold 27s or 26s because the market's supposed to break. So you do that because you want to be on the trade. And if it goes 6, 5, 4, you take something off, you put a stop at scratch, and it might go 3, 2, 1, and okay, perfect. But most times it comes back. You say, okay, well, if I'm short at 26, 27, my stop should be up at 5 ticks, 1, 2, 3, 4, 5, even. But I can defend it against 02, 03. So what do? Do you put a 4 tick stop and puke and then resell? Okay, I've done that. Or you say, nope, I like this a lot. My previous 3 sells were all good. I know, it's all part of your thought process. But yeah, I do a lot of selling. All right, why 16 ticks? Because the guy that taught me to set up traded 1,000 lots from the top step of the 10-year pit, okay, and was down there about 20 years before I met him. That's why. All right, people, and I'd be a little bit sarcastic, I guess, with it, but, because people always want the reason. I see it in the MTS room a lot, in the trial room. People are asking so many educational questions that, to me, they're not seeing the forest for the trees. I thought I could have wasted 3 years to try and figure out why 16 ticks. Oh, is it because the option guys, hedge at every, is it because the mortgage guys hedge? Is it because, who cares? A guy that trades 1,000 lots in the top step of the pit told me to use a 16 tick extension. Works for me. Why do I trade Dow and not the ES? Because I want to trade against amateurs. I don't want to trade against pros. I trade against pros in the bond market. S&P is all pros. Okay? I don't want to trade against pros. Mini Dow, the institutions don't use it. Very, very rarely they use a mini Dow. All right? You're trading it in a retail market. And the mini Dow will give you 6, 7, 8 ticks on a trade, while the S&P is chopping in a quarter or half a handle. All right. Well, when I take an S&P trade, well, I never do, but when I tell my clients, here's, and I have guys trading S&P, but if I say sell 1550s in the S&P, if it goes 1552 bid or 1550, wait, what did I say? Let me try it again. If I say sell 1550s in the S&P, 1550. If it goes up to 1552, bid, okay, two handles, then I'm wrong. I'm wrong. But I'm looking for that minimum on a profit before I trail a stop. Well, the S&P to me is like the bonds. You know, it goes a handle, it goes back a half a handle, it goes your way, another, three-quarters of a handle, then back again. Well, heck with that. Let me jump in the mini Dow. Let me take 6, 7 ticks, then I can trail a stop on it and have it be 20 or 30. That's why I trade a mini Dow. If you put on a runner, how far do you trail a stop behind in bonds? You know, well, first of all, I was going to make a joke because I almost never do it, but you got to give it room. You got to give it 4 or 5 ticks. I mean, you have to. I mean, and that's a problem with it because, you sell 10s and it's trading 4, so your stop's at 08, you know what I mean? I mean, you got a great trade on that may turn into just a regular trade, which I think you can't do. I mean, I tell people we can find 2-tick trades all day in the bonds, all right. But the key is when you get a nice one, when you got 4 or 5 ticks, you can't turn that back into a regular trade. And that's why I like you to consider trying to hand the trade off. You only trade from a 5-minute chart. Yeah, I don't. Yeah. And I have a old buddy who uses, I think, 15-minute charts to find spots and then takes them down to a 5-minute per entry. And I understand that people do that, but no, I don't. What is your ROI in percentage terms? I don't know what an ROI is. Sorry, I could not hear you reply due to misconnection. Do you think we'll see some bounce in 5- and 10-year notes? I don't view the market that way. When I post my letter tonight or tomorrow, I'll have a picture on there that we'll use tomorrow. Not having my charts in front of me now, we're right about the 2.5 yield in 10-year notes, and that's the whole ball game right there. Which way we go in the 2.5 yield. I had 135.05 yesterday for a very key bond price. We hung around that quite a bit, late in the session. The 10-year notes hung right around the 2.5 yield. That's going to be the answer to your question. Okay, who controls those two prices?
Jack, can you hear me?
Yep.
I have the advantage of a microphone. I just wanted to ask you a couple questions.
Okay. All right.
First of all, the most important question is, how do I sign up for your service? Could you go over that again?
I gave the guys my email. I want to just, I don't want to turn this into a sales promotion. And Marlon, I appreciate that. I appreciate that. But if this kind of trading interests you, if my take on the market interests you, and you want to give more information or see what goes on in my room, now I don't give trials. I just gave some trials for a group, and I was impressed. They were respectful. There's rules in my room. I'm not going to answer a non-client's questions at 7:35 in the morning. That's when I'm watching the market to figure out how we're going to trade the day. So my point, I'm not beyond giving a trial, all right? But if what I talk about interests you, email me, mention this thing, and we'll get a dialogue going, and we'll help you out.
Great. And my other question is, and I think you agree with me, is that the thing that you can't, 16-tick rules, those rules are all great, but there's also the feel piece of being in the market, and you've, of course, developed that over the years and everything. Where are you getting your kind of feedback for that feel? Is it from this dome, this price ladder you're looking at? Is it from charts? Is it from being in the environment in the pit still? Or where do you get your kind of feel for how the market's going?
It's experience. And that's what, I tried to share that with the MTS trial guys, because I think sometimes they're so geared into finding the way to tweak their indicators so that they can get a little more of a entry price. or they're so geared into learning another indicator that they can add to their other 50 indicators. And I'm kind of being facetious, but that they're not learning how to trade. They're not having a trade on sitting back and just now watching what the market does. They got long and the reaction of the market now. And as I just get more time under my belt, that's where feel comes from. And it's just being through enough different markets where you almost can say to yourself sometimes,